Avoid these 6 mistakes while investing in mutual funds, or your return could end up being zero. It is around 11 at night. A man is sitting with a mutual fund app open on his mobile screen. Some schemes are showing in red, some are barely flat, and some returns look as if, even after months of effort, nothing much has really been gained. Only one question is circling in his mind. Do mutual funds really build wealth? Or is this just a game in which the ordinary investor realizes at the very end that the mistake was not the markets, but his own? This is where the fear begins, because the fear of money sinking in mutual funds does not always come from a falling market. Many times, it comes from wrong decisions. And this is where curiosity is born. That when the industry size has reached nearly 74 lakh crore in AUM in March 2nd, 2026, SIP assets are also around 15 lakh crore, and equity funds have continued to see positive inflows. Then why do so many investors still look disappointed? There is only one answer to this. Loss in mutual funds is not always caused by the scheme. Many times, the investor weakens his own return through his strategy. First of all, understand one important truth. To say that mutual fund investors got only zero return in the last 2 years is not correct for every scheme. Mutual funds come in different categories. Their risk is different, their portfolios are different, and their behavior is also different. Yes, in the short term, because of market decline, mark-to-market losses, volatility, and wrong timing, many investors may certainly see flat or disappointing returns. AMFI's March 2nd, 026 note clearly states that broader equity indices had seen a continuous decline for several months during that time, because of which equity funds faced mark-to-market pressure on assets. But this does not mean that the mutual fund itself has automatically failed. Both AMFI and SEBA clearly say in their investor education material that the correct assessment of a mutual fund should not be done through short-term mood swings, but through time horizon, goal, risk profile, and discipline. And this is where the first big mistake begins: stopping SIP as soon as the market falls. When headlines about war, recession, global tension, or market crash start running, the confidence of many investors breaks. They feel that putting money in right now would be foolish, so they stop the SIP and think they will start again when the market stabilizes. It sounds practical, but this is exactly the step that hurts long-term compounding. SEBI's financial education booklet clearly says that the purpose of SIP is not to time the market, but to invest at regular intervals. The same booklet explains that rupee cost averaging helps the investor benefit from market volatility, because when the market is low, more units are received, and when it is high, fewer. AMFI's investor education presentation also clearly says, no need to time the market. This means that stopping a disciplined SIP when the market falls is often like running away from a discount sale. The second mistake is chasing past performance. Many new investors choose a fund simply by looking at which scheme gave the highest return in the last 1 year, 3 years, or 5 years. Then they buy that same fund as if they have caught a winning horse. But in the world of investing, the rearview mirror does not guarantee the road ahead. Both SEBI and AMFI repeatedly warn in their official documents that past performance is not a guarantee of future performance. This does not mean that past data is useless. It means that choosing a fund by relying only on that is incomplete understanding. A fund may shine in one cycle because a particular sector performed well, a particular style worked, or one theme became fashionable, but that same strategy may underperform in the next cycle. So a smart investor does not look only at past return. He also looks at category, risk, expense, consistency, mandate, and whether it matches his goal. The third mistake is getting scared by a fall in NAV. Many investors think that if the NAV of a mutual fund has gone down, then the fund has become cheap, weak, or the money is almost finished. Some people buy looking at a low NAV, and some get scared looking at a high NAV. But the reality is completely different. AMFI's introduction material clearly explains that units are issued to a mutual fund investor at the prevailing NAV, and your gain or loss depends on the NAV at which you bought the units and the NAV at which you later sold them. NAV is only the price per unit, not a quality certificate. A low NAV does not mean the fund is a cheap gem, and a high NAV does not mean the fund is expensive. The real question is what assets the fund is investing in, what its objective is, how much risk it carries, and whether it is suitable for your goal or not. The investor who reads NAV incorrectly like a share price often reaches the wrong conclusion. The fourth mistake is to keep waiting for the perfect time. This is perhaps the most dangerous habit, because in it, the investor feels that he is showing great wisdom. He thinks, let the market fall a little more, then I will enter. Or else, the market is too high right now. I will invest when a correction comes. Then some more news comes, some more fear comes, and months pass. SEBI's booklet clearly says that SI protects an investor from trying to time the market. AMFI's investor presentation also teaches the same thing. That long-term disciplined investing is more powerful than market timing. When you keep searching for the perfect bottom and lose time, then often your biggest loss is not the market, but delay. In the world of investing, many times not invested is also a hidden risk. Time keeps passing, inflation keeps working, and your money keeps getting weaker, just sitting in a bank balance. The fifth mistake is putting all your money into a single scheme, a single category, or a single theme. Some investors get attached to one fund, sometimes because of a friend's advice, sometimes after watching a social media reel, and sometimes after seeing a recent return table. Then they think that when this fund looks the best, put all the money into this one. But the basic philosophy of mutual funds itself is diversification. In SEBI's educational material, mutual funds are explained in the context of different asset classes and schemes: equity schemes, debt schemes, hybrid schemes, solution-oriented schemes.
meaning each scheme can have a different role. If your entire money is in a single aggressive category and the market gives a correction in that same segment, then your entire portfolio psychology gets shaken. Diversification is not just a technical word for reducing risk, it also gives the investor emotional survival. When there is balance in the portfolio, the investor takes fewer panic decisions. The sixth and perhaps deepest mistake is investing without a goal. Many people start SIP simply because everyone else is starting it. Someone said it will save tax, someone said wealth will be created in the long term, someone said mutual funds are right. So the account got opened, the SIP got set up, and the journey began. But just after a few months, when an emergency comes, a gadget has to be bought, a travel plan is made, or the market falls, that same investor redeems the scheme. 𝐼's investor education presentation places special emphasis on goal-based investing. 𝐼's website also clearly says that investment goals are different for different people. Children's education, marriage, house purchase, retirement expenses, and product selection should be according to that. A mutual fund investment made without a goal often cannot become disciplined. And when discipline does not happen, then compounding does not write a story. Frustration does. Now understand the real turning point of this whole story. Many times, mutual fund returns may temporarily look dull because of the market, but the investor's long-term outcome often depends on these 6 mistakes. If you stop SIP, chase the past winner, get scared of NAV, keep looking for the perfect time, do not diversify your money, and do not set a goal, then even a good product can become a bad experience for you. On the other hand, if you invest after understanding the category, choose funds according to your risk tolerance, do not react to market noise, and give enough time, then that same mutual fund can become a disciplined wealth-building tool for you. In 𝐼's material, it is said that actively managed equity schemes should be given patience of 18 to 24 months, which means this product is not made for daily excitement, but for a reasonable time horizon. There is one more subtle mistake that many people make, and that is ignoring cost. SEBI's information on direct Visa regular mutual funds clearly says that in regular plans, because of intermediary commission, the expense ratio is higher, while in direct plans, this cost is relatively lower. This does not mean that every investor should take only direct plans, because beginners may also need guidance. But it certainly means that while choosing a fund, one should understand not just the name and return, but also the cost structure. In the long term, even a small annual difference in cost can have a noticeable effect on the final corpus. Many investors run so much after returns that they do not even notice cost leakage. Slowly, this unseen factor reduces the speed of wealth creation. So the real understanding in mutual funds is not which fund will give multi-bagger-like returns next year. The real understanding is which mistake is repeatedly pushing you below average. The market will go up, it will come down, news will change, sentiment will change, global tension will come, correction will come, recovery will also come. 𝐼's March 2nd, 026 note mentions market turmoil and mark-to-market losses, but that same note also shows positive equity, inflows, and growing industry size. Its meaning is clear. Serious investors are not running away from market volatility, they are continuing by treating it as part of the investing journey. The only difference is that an informed investor sees volatility as a process, while an anxious investor starts seeing it as a personal attack. So if your mutual fund returns are not exciting you right now, then first do not ask what mistake the fund made. First ask whether you stopped the SIP in between, whether you chased the top performer, whether you panicked after seeing AV, whether you lost years while waiting for the right time, whether you left the portfolio dependent on just one scheme, and whether you invested without a goal and then broke discipline halfway through. The fear of zero return in mutual funds does not always come from a market crash. Many times, it is created by the investor's incomplete strategy. And this is the biggest lesson of this whole story. In the race to build wealth, you have to defeat your own mistakes before you defeat the market.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.